Hey everyone, this is take 2 of the insurance video. I trusted an app I don't know how to use, so I'm doing this again, and I'm going to try to keep it short and sweet. Insurance is one of the larger line items. You'll always see it, even if they only put 2 or 3 expense line items into a P&L. Everyone knows you need insurance, so they typically will include it. This is very property and location specific, so there's not a whole lot of rules of thumb of X number of dollars per unit or anything else to look at. But when you're looking at an offering memorandum, one quick rule of thumb you can trust is try to see if the insurance is about 50 to 100 basis points of what they're saying the valuation is. If it's in that range, then you're probably okay from a smell test to utilize their number or something that's a close approximation of it for the sake of your initial underwriting and valuation. If it falls into an extreme of that, then that's where you need to be a little bit more careful. If it's much lower than that, then that means the current owner is probably self-insuring some or all of the property or not getting adequate coverage. I have one client that self-insures all their wind and flood in the state of Florida. It's a risky play, but it's one that he decided he wants to do, and he has a lender that allows him to. But when he goes to sell those properties down the road, someone's going to see an artificially low insurance number on the P&L, and they need to be able to account for that. On the other extreme, if the number is way higher than, say, 100 basis points plus of the valuation, then there could be issues. It could be in an extreme flood zone. They could have had an extreme amount of claims on their insurance policy during their hold period that's increased their premiums. So just keep an eye on that and understand what you're getting yourself into. Now, there are all kinds of insurance you could take down. The one that you're most likely to think of is your traditional property casualty insurance. That's what you have on your primary residence. It's what people think of when they think of insurance. And you know you have to get that. But also be aware of some other things you may or just want to take. There's loss of rent. If you have a 40-unit property and it's 8 units and 5 different buildings and one building burns down, you still have debt service to cover. You still have expenses to cover. But you're going to lose a significant portion of your cash flow while those properties or units are being redone. So loss of rent insurance is a good one to have, especially if you have investors you have to answer to. There's also E&O insurance if you're writing your own leases. There's flood, wind, earthquake insurance depending on the location in the country. Some of those may be required, some may not be. At the end of the day, you have to decide what your risk tolerance is, and more likely than not, the lender that you're using is going to decide what your risk tolerance is, especially if you're using agency debt or bank debt, because they're going to have very specific requirements of what your coverages need to be, and you're going to have to adhere to those whether the offering memorandum included those numbers or not in their valuation. So, take a look at the insurance number, see if it falls into that range. If you want to be a little more specific, then I would recommend while you're putting together your property managers, your mortgage brokers, your inspectors, people on your team to do an initial review of all of the deals you're looking at. You may want to add 1 or 2 insurance policy providers. They can run quick desktop reviews. They can look at the age of the property, the quality of property, different liabilities such as pools, fitness centers, so forth, and at least be able to throw out a general number that you can plug in for the onset of your valuation. So insurance is necessary evil. You want to cover yourself. If you have investors, you definitely want to cover your investors. You want them to invest with you again. You need to cover your lender. They're going to require it. So keep an eye on the insurance number. If it falls in the range, it's okay for now. But as you start digging down, once you go under contract, make sure you really get an understanding of what the coverages were and what the coverages need to be, and make sure you're properly covering your property and covering your ass. And I will leave it there because NHL playoffs are starting tonight and I want to get home. So go Bolts, and I'll talk to you next week.